of Canada held its key interest rate at 5% for the sixth consecutive time. BOC Governor Tiff Macklin has a message for anyone feeling impatient about a rate cut. He says, quote, if we lower our policy interest rate too early or cut too fast, we could jeopardize the process we've made in bringing inflation down. Well, does our next guest agree with this? Joining me today to discuss what the latest rate announcement means for Canada's economy, for you, for all investors, is renowned economist Don Drummond. Don has held several senior roles at the Federal Department of Finance, where he was responsible for economic analysis, fiscal, tax policies. He later served as Senior Vice President and Chief Economist at TD Bank, and is currently Fellow in Residence at the C.D. Howe Institute. Welcome back, Don. Really glad to have a chance to speak with you today. How are you?
I'm very well, thank you.
Good, good. So you've been watching all these machinations very carefully, the economic backdrop into which the governor of the Bank of Canada decided not to cut and to hold interest rates. We'll invite everyone to send their questions into you, but I'll start out with a couple here. Why did he hold?
Well, I think things are shaping up pretty much the way they would like. They do repeatedly document in their monetary policy report that inflation pressures are subsiding. Not just the overall headline inflation that everybody looks at, but the three underlying measures. They particularly put a lot of emphasis on what's happened in the last 3 months, and they point out that the measures they look are just slightly over 2%. So definitely getting into that range. They do emphasize we're in a position of excess supply. So they have said right back from 2021 that demand in the economy exceeded supply, and that's one of the reasons inflation was going up. And now they're saying we're in the inverse. And even with an expectation of stronger growth next year, they're still saying the economy is going to be in slack. So they got to be kind of pleased with that. They worry, they're paid to worry. Wages are not increasing quite as fast as they were 6 months ago, but they're still increasing at a pretty good clip, and productivity is pretty dead. So there is some pressure for unit labor costs. So not everything's are lining up. But I think the intriguing question for the Bank of Canada is not so much why they don't cut. What's the harm of doing a lousy 25 basis point cut? They put a lot of emphasis that their so-called neutral interest rate, the interest rate that's consistent with steady 2% inflation, is between 2.25% and 3.25%. They're at 5%.
Which is not 1% ever. I mean, we'll make that point.
No, and that should be our benchmark. At some point, 2 or 3 years down the road, if the economy is operating in a normal fashion, where might interest rates be? Well, they've given you the clue on that, 2.25% to 3.25%, but we're at 5%. So what's the great harm done by 4 3/4? That's still very restrictive monetary policy. So I really think they should be increasingly asking themselves the question. They don't have to go to 2 3/4 and 3.25% anytime soon. But what's the harm of starting that process and indicating we're way above a neutral rate? We're applying a lot of monetary restraint. We could reduce that restraint and still be hedging against inflation.
Okay. Would the Canadian dollar just rocket downwards?
Well, that's a very nice introduction to happening what's the United States. The two main things going in the United States, their economy seems to be impervious to the interest rate increases, just chugging along with the great momentum, including the consumption. And of course, we just got their latest inflation numbers, and they tend to look at just simpler measures, CPI excluding food and energy, 3.8%. That's a long way from the Federal Reserve Board's target. So you're starting to see increasingly the discussion in the United States is, well, maybe they're not going to go quite as soon. Maybe they're not going to go quite as big in the declines as we did. So yeah, we could see some further weakness of the Canadian dollar. But the Bank of Canada can't be worried about that. Yeah, they would worry about an extent that will be another source of inflation, but they really have to look at the overall monetary conditions, and they're still quite tight in Canada, including buying back government bonds, which is withdrawing monetary stimulus from the economy. We've got the fiscal pressure. One of the things they may have been waiting for is the budget on April 16th. They may be worried that that's going to be another round of spending.
It's been delivered in the course of the last week and a half. Don't they have it?
They can't like what they've got. Let's put it that way. I think they may still be hoping on the edge of their seats that somehow, despite all these spending increases, it's not going to raise the deficit even further and add further to the inflation pressures. That may be one of the reasons why they held off. Maybe they just, hey, we want to see what's going to happen on April 16th. We've been seeing the provincial rounds of budgets, and they're not adding any restraint either. They're adding a lot of spending, including Ontario and BC and big fiscal difficulties. So you're seeing a fair bit of fiscal stimulus, which is going to compromise the ability of the Bank of Canada to get their rates down.
Right, right. Really interesting. Let's talk about mortgages for a second. I mean, for many individuals, for investors, and also when you look at the banks as investments, or mortgage providers broadly, it goes beyond just the big banks. What is the mortgage story of this hold?
Well, the thing that drives me crazy is there's often an implicit assumption in articles about interest rates and mortgages rates, and if and when the Bank of Canada starts to reduce its policy rate, and I emphasize the word its key policy rate, that's all they can manipulate, that mortgage rates will go down. And that may have been true a few years ago because most mortgages were variable interest rates and they changed with short-term interest rates. But given the increase in interest rates and how many people got burned on variable interest rates, almost all mortgages today are fixed. So if you have a 5-year fixed term mortgage rate, the bank prices the interest rate on that off the 5-year bond. And 5-year bonds don't necessarily respond to the Bank of Canada rate. In fact, they can often respond in an inverse fashion. If the markets, for example, thought that a cut in the Bank of Canada's policy rate was going to lead to higher inflation pressures, they may actually push up that 5-year bond rate, which could actually push up mortgage rates. I don't think that would happen, but we have to drop this one-to-one assumption that just because the Bank of Canada lowers its rates, all your mortgage rates are going to go down. Yeah, variable mortgage rates, right, but there's not very many of those around.
So just crispen that, make it crisp for us. If the Bank of Canada cuts next time, what does it mean for mortgages?
Probably not a lot. I guess you could look at the glass half full part. It means there probably won't be any further upward pressure on them, but it does not necessarily mean that they're going to go down. And again, just as you pointed out, we shouldn't be expecting the Bank of Canada's policy rate to go back to 1% or even lower anytime soon. That neutral rate's 2.25 to 3.25. At some point, we have to accept that while it seems shockingly high to have mortgage rates where they are right now, by any historical standard other than the last 2 decades, these are not particularly high rates. They're not particularly abnormal.
What does it mean for the housing market, Don?
I think just getting a Bank of Canada rate cut from that psychological perspective that there won't be any further increases should revive it. The demand is there. There has to be some pent up demand because sales have been down in the last year, and our population increased by 3%. This is unprecedented. I mean, we haven't had such a big increase in our population since 1956, and that was the baby boomers starting, and we had a lot of refugees coming from Europe. Very extraordinary circumstances. They're going to live somewhere. Apartments, homes, condominiums, the demand is there. We need some kind of signal. Markets do kind of pick up quite often in the spring. So, prices are high. I actually hope we're not going to see any big increases in prices that will dent the affordability. But I do think as soon as there's a confidence that interest rates will at least stabilize and possibly come down, we will see a firming up of the sales.
Interesting. Okay. So let's go to growth. You sort of talked around it there a little bit, but let's zero in on it a little bit. Part of the growth story is the fact that there has been an influx of residents to Canada, those who are applying for citizenship and otherwise. But that has given a boost to growth. They've changed immigration laws. Just talk to us about growth based on that.
Yeah, I really think we need to change the way we analyze, and particularly the way we report growth. We have for decades had slow, steady population growth, and it really didn't change the way you looked at what was happening in the economy. But when you have 3% growth in a population per year, and let's say output grow by 2%, that is not a very good outcome. And I find it's interesting, this debate, are we in a recession or are we going to go into recession? For what matters to an individual, i.e. our gross domestic product per person or per capita, we are in a recession and a fairly deep one. So our output growth has been flat for the last couple of quarters and the population is growing rapidly. So our output per person in Canada, which is what matters to us as people, has actually been going down. And you can see in the Bank of Canada, because of this population growth, they said at the moment, the potential growth rate of the economy is 2.7%. Again, seems like a high number, but it's not very impressive per capita. But once we flatten out on the regular immigration totals and we see the decline the government's trying to implement in temporary foreign residents, we're going to see that potential growth rate go back to a fairly low number. So the economy is not really in per capita terms doing well right now. And our longer term prospects keyed off very modest productivity gains is not very promising.
Okay, I want to talk about the productivity gains and how we sort of fold this all in together. Let's fold that discussion of productivity into the business investment story. I mean, in fact, we seem to see all these pre-budget announcements or budget, I don't even know what they are, for the federal government, talking a lot about productivity, in some cases AI, obviously defense is a big piece of it. I mean, they're sort of alluding to all of this fixing parts of productivity. And you've said in the past that business investment is absolutely essential. Now, I don't know if that needs to be fiscal business investment or if we need the sort of foreign direct investment, more direct investment from Canadian investors, but there's going to be injections here. Are they going to work for productivity?
Well, I'm talking about physical. So machinery and equipment in particular, non-residential construction. I don't think we're going to see a lot on the non-residential construction side, particularly in the commercial real estate, just given the changes in the hybrid working and the vacancy rates we've got in many of the urban areas. But machinery equipment is key. We tend to measure productivity per worker. And of course, the easiest way to increase your or my productivity is to give us a better machine to work with. We have always underinvested that. We've always had a big gap with the United States and some of the other economies, and those gaps have been growing. We're particularly underinvested in IT and particularly in the software, somewhat in the hardware, but particularly the software. We don't have as much. We don't use it in a sophisticated fashion. Yes, part of it could be foreign direct investment, but I'm most particularly talking about Canadian companies. Why are they not building for the future?
Why are they not building for the future?
That's a question I'd love to know the answer to. I wrote a piece way back in 2012, Confessions of a Serial Productivity Researcher, because I said for a long time I blamed our poor productivity on our bad monetary and fiscal policies. We had high inflation, we had high interest rates, we had high government debt, we had high tax rates, we didn't have free trade agreements, and then lo and behold, most of those things got addressed to some fashion, and yet productivity didn't pick up. Right. So it meant we had to look at more firm behavior. But if we go back to 2012, at that point, you and I and other researchers outside Statistics Canada were not able to access the firm level data from Statistics Canada. It was held confidentially. That has changed, and we're slowly getting some research, but so far we haven't really got a lot of answers. It speaks to a lack of ambition, quite frankly. The classic example of that was between 2000 and 2008, where most of the big mining companies in Canada faced a choice of going from third or fourth in the world to one or two, and instead they sold out. You look at the counter example in Australia, they did a lot of the acquisitions. We tended sold out. Why? They made a killing on their stocks. The executives and their shareholders did very well for the moment, but they weren't building for the future. Why are they not building for the future? Why do we have so many corporations in Canada that have their income just under $500,000 a year? Why are they not shooting to be $2, $3, $5, $10, $50 million companies? We see more of that in the United States and some economies and not here. Is it a cultural thing? I don't know. I don't think it's particularly a policy thing. I would like to see a corporate income tax reduction to rebuild the advantage, but we don't have a tax disadvantage. We've got lots of accelerated depreciation programs. Businesses said they want that. They've more or less got that, and yet they still don't do the investments. Despite the pandemic and everything else, corporate profits, retained earnings are fairly high. That doesn't seem to be the problem.
Interprovincial, and what about just the idea of red tape? You know, all levels of government to get projects moving.
There's absolutely no excuse whatsoever in an economic union to have barriers amongst themselves. That is a disgrace. They're important, but they're not the single reason why we're not doing business investment. And red tape, yeah, we should streamline that. We've had many efforts that in really done that. That's part of it too. But again, that doesn't seem to be the obstacle. Okay. In some examples, we've had a lot of we know we need critical minerals for this clean growth transition. And we talked about that the last time. It can take 15 to 20 years to get a project. We have to deal with that. That's the red tape. That's the federal, provincial, municipal, indigenous rights, the consultations. There's a whole layered process. We have to speed that up, but that doesn't explain all of the weakness.
What could we get that down to? Because I think you've mentioned in past, it's sort of between 12 and 15, I think it's like between 12 and 15 years to get something up and running.
That would be if things going reasonably well. It could be even longer than that. I mean, I'd like to see something more in the 5 to 7 year time range. And other countries are doing it. Other countries may even come into Canada and do it with our resources. That would be pretty pathetic if we allowed that to happen.
There are, would you say there are signs that are hopeful though within our economy? Like what have you seen again over the post-pandemic years or the post? I don't know where we begin with that because it was such a rolling pandemic. But I mean, in the last couple of years, are there signs of hope within the economy? I mean, we are sitting at very high interest rates compared to where we were back then, and we're chugging along somehow.
I would say the resilience of the economy that was proven through the pandemic. I mean, if we go back to the late February and March of 2020, it appeared that the economy was going to crater, and it really looked really bad for about a quarter, maybe 2 quarters, and then it stabilized and then it started to recover. People were resilient. The infrastructure of the economy, the way people interacted, corporations reacted, proved to be quite resilient. And the moment, I would say the most impressive thing is the resilience of Canadian mortgage holders. You know, these people who had variable interest rates that were extraordinarily low or on the fixed monthly payments, or people who might have had a 1.6% fixed term mortgage and they're looking at 5 and 6%, they are not defaulting. Very few of them are even in arrears. Lots of them are even taking advantage. You often get to pay 10 or 15% of the principal. You can pay that down per year without a penalty. Lots of people are doing that. I don't know how they're adding up their budget. I mean, their wages are going up, yes, but not as fast as inflation did for a while. And food in particular is going up very rapidly. They've got to eat. Rents are going up, but they're squeezing something else and they're keeping the mortgage market relatively stable. We're not seeing anything like the 2008 mortgage meltdown we saw in the United States. So that's encouraging.
So that's encouraging. There are tons of questions rolling in here. You are giving lots of food for thought to a lot of people joining you here today. Let's stick with mortgages just for a second. This question, if mortgage rates would move more, well, continue to move with short-term, if they moved with short-term rates, could we see a move back towards variable rate mortgages?
Yes, I would think so. Historically, there's not been very many periods where you have not ex post done better by taking a variable interest rate. Of course, there's a few examples where you got burned. One of them just recently, when interest rates went up very much. And in my era, of course, when we saw the really wrap up of the late 1970s and the early 1980s, where the short-term interest rates, mortgage rates hit over 20%. Those burned people and they moved away for something. But on average, over time, you pay a premium for getting the confidence of the fixed term rates, and if you're willing to take a bit of a risk. So when people get burned, it takes a while to come back, but they will come back, and they'll come back into favor for a while if and when we get lower rates and we get them a confidence that they'll remain in that lower range.
Here's another one. So let's go into this one. This has to do with sort of the productivity discussion. So a lot of people on social media remark that the biggest issue in Canada is that the Canadian government invests in almost everything that has to do more on the energy side of things. You might add housing in there, I don't know. But not enough on tech and AI. Do you agree?
Well, of course, maybe 4 days ago, I might have given a different answer, but we haven't seen the details, but we just saw billions of dollars being addressed to AI support in one of these many pre-budget leaks, if I could use that word very loosely.
They're like broad announcements. They're not.
Yeah, they're not leaks. Somebody's opening the spigot. The water's not just pouring out. So we'll see that. I mean, in fairness to the government, yes, there are a lot of subsidies spending and tax-wise directed towards the fossil fuel industry, but they have been pumping a lot of money or making a lot of money available to support the transition to clean growth. We haven't seen as much take-up as we might like, but they are playing both sides of the equation, if you want.
Yeah. Okay. This question digs right into that. So let's go into the carbon tax. Given the increases in the carbon tax, what are your thoughts on inflation?
Well, absolutely, it increases inflation. The Bank of Canada, again, thank goodness for them, they do a lot of analysis. They say over the last couple of years, when the carbon tax has been going up, and that's at the same pace it's now going up, it's added 1/20th of the increase in inflation. So the overall excess demand for a while, the supply side shocks around the world have been the dominating factor, and that will be continuing the factor. And we have to emphasize again, on the household basis, it's pretty much neutral because most of the proceeds from the carbon tax go back to household rebates. Most people don't seem to recognize that, and I think the government's done a poor job of making that clear. People are thinking that's a hit on the household budget, but it's not.
Right. Okay. Fascinating to get your thoughts on all of these different areas. There will be more questions coming in, I think, as we go along here. Let's go back to sort of the monetary policy discussion, things that ultimately are the inflation story. I mean, what are the odds in your mind of actually seeing a rate hike? I mean, they're staying in this neutral area of hold so that we think they can cut, but there are these swirling discussions that certainly in the US, there may be no cuts and that they have to stay here in case they have to hike. So just take us there a little bit. What sort of odds do you put on that?
Well, this is where I think, again, levels really matter. I'll come back to this, their rate being 5% and their estimate of a neutral rate of 2.25 to 3.25. And they very explicit in their document, they use the midpoint of that of operational. And when they're doing their projections, they're assuming in the longer term, they're at that midpoint, 2.75. So they're already 225 basis points above a neutral rate. So they're already providing a lot of stimulus, a lot of restraint. Would it make any difference? Would it help if they added even more? I don't know. If it's 250 basis points is not going to be very different from 225. If they were below the neutral rate, or even if they're in that neutral rate, I would say, yeah, given all these inflation pressures, they should increase it so they're moving north of the neutral rate, but they're already way outside of the neutral range. And, their underlying measures of inflation 3 months annualized are just above 2%. So in real terms, their policy rate is about 3%. If you look at it that rate, that's quite high. So they're being quite restrictive. I think restrictive enough. A very interesting analysis came out yesterday by the CD Howe, suggesting they're at a danger of actually being behind the curve. If you really believe their own forecast, which says that there's going to be slack in the economy through 2025, we're going to be down to a measured year-over-year inflation by by the end of 2025, we'll be down to 2%. They shouldn't have a policy rate that's over double the neutral rate. They should be lowering it somewhat right now.
So does that have to do with sort of the variable lags and so on? I mean, the idea that we're still getting used to pricing in the lags, whatever, of the height of interest rates that we're at right now. It's still working its way through, and therefore this fall off in inflation, say in 2025 or whatever the estimates are.
I think a lot of it's human nature.
Okay.
If you make
like
the
a
same
cognitive behavioral thing, yeah.
If you make the same mistake repeatedly, aren't you going to be incredibly averse to making it again? And they made the mistake. I will say they made the mistake. I don't know if they will confess it. They made the mistake of having interest rates too low for too long. The worst in that situation would be to lower them prematurely. And I think if you had to take your pick between lowering too early or waiting too long, you would cover yourself and not repeating the same error. It's sort of like for those golfers out there, if your last 99 drives were a slice, maybe instead of trying to hit the 100 straight, you might want to try a hook. You probably won't be able to pull it off, but you don't want another slice again.
Okay. I'm with you. I've played a little bit of golf, so I kind of know what you mean. I'm not sure if everyone else knows what you mean, but yeah, I'm with you there. A little bit to the US. So we heard yesterday, for instance, various voices on Republican and Democratic sides discussing the CPI, which is what happens. There seems to be this general thought, and I don't know again if it's right or wrong, but that if the Fed is going to move, they want to do it either well before the election or after. It's sort of one of those, you want to get caught in the middle because you have these voices from either party starting to chirp and talk about inflation and cuts and so on. Does the Canadian perspective have anything to do with what the Fed is doing? Our economy is different. We have different reasons why we would cut, or I mean, the economy is different, has different reasons inside it. Do we also want to get away from the chatter around inflation towards the American election, or is it really has nothing to do with it for us?
Well, we are the quintessential textbook small open economy, and we're most open in the United States. So it really does matter, not the politics per se, but if their economy continues to grow very strongly and they continue to have strong inflation pressures, let's face it, we're going to import that. Right. I mean, there's no clear example of that in the financial crisis. We could have a lot of sympathy for ourselves. We did not have the bad regulation they did. We did not have the recklessness in the mortgage market. We did not have the Lehman Brothers who leveraged themselves over the top, but we paid a price for that. Mm-hmm. And despite us doing everything wrong, our banks had trouble borrowing money for a while, and our housing market got hit to some degree, not the same as ours. That's the nature of it works to our advantage. We've got a big market just there that we can sell our products to, but we kind of go where they tend to go. So it really does matter. But it is fascinating, your point, and I'm in the United States right now, just how politicized everything is. And when you do polls of the perceptions of Americans, how the economies do, you have such extreme reactions, whether you're Republican or Democrat. The Democrats think the economy is doing very well, and the Republicans think the economy is doing very poorly, but they're living the same experience, and they're open to exactly the same data, and they interpret it so differently.
Yeah, well, you've worked for government. You know how that works.
I'm not sure. We like to think we're terribly different, but I don't see the divides on an economic basis to that extent in Canada, and that people will interpret economic data totally different depending on their political leaning.
I want to ask you whether you think the federal budget, which is coming up next week, as you mentioned, we've heard many pieces of it announced actually by the Prime Minister in most cases. So it's out there. What do you think we need to look for? This is on the tax side of things. You worked in the finance department on the tax side of things. What is the tax policy outlook for you based on whispers that you're hearing or seeing?
I have a great fear I'm going to have to go back to being ADM at tax policy and clean it up. It's not my first desire. I did that in the mid-1990s, but they are creating Swiss cheese out of the tax system. They've already demonstrated their openness to that. And, look at the carbon tax exempting home heating fuel, one of the higher carbon. The list is endless. Very striking, the press conference of the Minister of Finance, who ruled out tax increases for the middle class, but steadfastly refused to move out tax increases for higher income individuals and corporations. I fear there'll be something like that, and I fear it will be gimmickry. I have always said, don't worry about things like an increase in the inclusion rate for capital gains, because we don't have indexation of capital gains. I wouldn't put them past to do that. We already have a marginal tax rate, federally, provincial, of over 50% for high income earners. We've demonstrated that increasing that would actually lower revenues, but I wouldn't put it past for populist reasons to do that. I'm very fearful what we're going to see. We've had all these spending announcements, and I don't think there's going to be a source of funding identified for them. It's just going to be more borrowing. The economy is roughly in balance. Yeah, the Bank of Canada says there's excess supply, but just slightly. We shouldn't be running huge deficits. I think the deficit will be even bigger. And I think we're going to see a lot of gimmicks that are going to undermine the confidence and the security of our tax system.
In one word, should that keep the Bank of Canada on hold longer?
I think that may be one of the reasons why they didn't cut. They want to see what's going to happen in the budget and how much more difficult that makes their life.
Don Drummond, a pleasure to speak with you, especially after the Bank of Canada announced and just before the federal budget. We appreciate your time and your incredible intelligence. Thank you.
Okay, always a pleasure. Thank you.